$2, 5M disappeared the day your acquisition closed, 1 month too early. You built a $20M company. The buyer made an offer. Everyone said yes. Then your tax guy whispered 3 words that changed everything. You missed it. You'd held the stock for 4 years and 11 months. IRC Section 1202 requires 5, 1 month short. The $15M gain you thought would exclude $10M tax-free just became fully taxable long-term capital gains. Instead of owing $1.25M in federal and state tax on the $5M excess, you now owe $3.75M on the full $15M. That's not a mistake. That's a $2.5M cliff most founders don't see until it's too late. Let that sink in. $2.5M gone because of a mere 30-day difference. This is not just a tax issue, it's a wealth preservation issue. But here's what most tax advisors won't tell you. There are 3 legal loopholes that might still save your millions, even if you're close to the cliff. Stick with me, because I'll show you exactly how to use them after we break down the rules. IRC Section 1202 excludes 100% of gains, but only on stock acquired after September 27, 2010, held for 5 or more years by the original owner, in a corporation with $50 million or less in gross assets at the time you bought the stock. You also have to be an active participant, not just a passive investor. And there's a participation requirement. You can't have more than 80% of the corporation's assets in passive investments. Then comes the killer, the aggregate basis limit. You can exclude gains only up to the greater of $10 million or 10 times your basis in the stock. So on a $15M gain, only $10M excludes. The remaining $5M gets taxed as long-term capital gains at roughly 20% federal plus your state rate, typically 23% to 25% combined. Let's drill down on the numbers. If your basis in the stock was $500,000 and you sell for $15M, your gain is $14.5M. With Section 1202, the first $10M is tax-free, leaving $4.5M taxable. At 23% combined rate, that's $1.035M in tax. But if you miss the 5-year mark by 1 month, the entire $14.5M gain is taxable, resulting in $345M in tax. That's a $2.31M difference purely because of the timing. Now here's the question nobody asks. What if the buyer won't wait? That's where it gets interesting, because some founders do hit 5 years, but others face acquisition pressure, a buyer's deadline, investor demands, market conditions that force the decision before the calendar allows. On a $15M gain, the difference between hitting the 5-year mark and missing it by 1 month is roughly $1.25M in tax on the $10M excluded portion versus $3.75M on the full $15M. That's a $2.5M swing. Here's where the open loop tightens. 3 legal strategies some tax advisors mention if you're near the 5-year mark and an offer is incoming. First, structure the deal as a stock sale plus a deferred earnout. If the earnout vests after you hit 5 years, parts of the gain might qualify. Second, negotiate a delayed closing. Push the transaction close date past your 5-year anniversary if the buyer permits. This is rare, but happens. Third, use a holding company structure or recapitalization before the acquisition to reset your basis and holding period. But this is aggressive and requires IRS ruling in some cases. None of these are automatic. All depend on the buyer, the deal structure, and your specific circumstances. But wait, there's another layer most founders completely miss. The Tax Cuts and Jobs Act introduced a 20% deduction on qualified business income, QBI, which could reduce your taxable income. However, this deduction is subject to phase-outs and limitations, and its interaction with Section 1202 can be complex. A thorough understanding of both provisions is essential to maximize your tax savings. So what should you actually do tonight? If you're a founder with equity and you're anywhere near year 4, audit your own holding period today. Pull the stock certificates or cap table entry showing the exact date you received the stock. That date plus 5 years is your Section 1202 cliff. Calculate your basis, what you paid for the stock, plus any vesting schedules that might have reset it. Then run the math. If an exit is in motion and you're 90 days away from 5 years, you now have a concrete number to negotiate with. If you're 4 years and 2 months in, you know the timeline. The IRS clock is fixed. The acquisition clock is not. That's your leverage point. You have the power to change your tax outcome. It starts with understanding your holding period and basis. Don't let a lack of knowledge cost you millions. A $15M exit at 4. 9 years costs you roughly $3.75M in federal and state capital gains tax combined. That same exit at 5. 0 years, with full Section 1202 eligibility, could exclude $10M of gains and cut your tax bill to around $125M on the excess. Missing the window isn't carelessness. It's a structural gap in founder tax planning that almost nobody discusses until the deal is live. The tax code rewards those who study it. Don't be a victim of the $2